Hey everyone, hope they're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive right in. Take a look, see what's going on today. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com, where I dive deep into all these topics, sectors, looking for investment opportunities, sharing them with everybody in the community, sharing my knowledge, wisdom about the markets, conditions, technical analysis, ratios, all of those things. If you want to learn about investing, I definitely would sign up. Use special as the coupon code where you can get 50% off the first month only on a monthly membership and a larger discount on the yearly membership. And if you're in a monthly and you want to sign up to a yearly, you can obviously sign up to the yearly from the monthly and use that code again for further savings. All right, Ian Castle, which I thought is true here. He says, we often let our last investing experience influence our next investing decision. If we're coming off a big win, we will likely dabble and invest the proceeds quickly in more ideas where we did less work than the original big win. You invest a little too loose and with too much bravado. Then you act surprised when the market slowly chips away at the gain you deployed into all of your new half convicted ideas. If we're coming off a big loss, we will focus on making one big bet and doing exhaustive analysis before pulling the trigger. So exhaustive, it is to our detriment. We play the game a little too tight because we can't take the mental anguish of being wrong again. When you need a hit, when you need a win, you rarely get them. It's like the market can smell your desperation. Just like Goldilocks and the three little bears, the mental sweet spot is right in the middle. You must find great investments but remain impartial about the short term stock performance. It's a bit like this Lou Brock quote: show me a guy who's afraid to look bad, and I'll show you a guy you can beat every time. Your advantage is often your willingness to look wrong for a few quarters before being right. Delayed gratification. Well, I mean, I'm trying to make sense of what this guy's saying. Do I exhibit those traits? What do my entry points look like? I think really what it takes is you need to know what the game will allow you to do. The game being investing. So, what is the game? What can you do? Where are the edges? How do you know when you're wrong? How do you know when you're right? What does it look like? And that's really a function of knowing the game. So, risk is not knowing the game. Risk is not knowing where the edges are. Risk is not understanding when to hold and when to sell. And I'm not saying that I know all the answers. That's definitely not the case. I don't know all the answers. But there's certain things that you can replicate in the market that you need to know where those edges are. So for instance, I'll name a few for everyone. So when I think of like the edges, if you're trying to buy at a potential ultimate bottom or something very low, more than likely you're not going to buy the bottom of the bottom. So you're going to have to live with some sort of loss in the beginning when you first buy it. And that's why I cost average into positions, is because I won't get the bottom of the bottom. And that's what he means down here is he says, you must find great investments but remain impartial about the short-term stock performance. It's a bit like this Lou Brock quote: show me a guy who's afraid to look bad, and I'll show you a guy you can beat every time. The beginning, you can show a loss because you'll never get a perfect entry trying to buy something that is incredibly low. But there are things that you can look at before that. It doesn't mean you'll be perfect. And I think that's where the edges of the game are. It's understanding that you may have to endure a slight loss or a loss in the beginning. You have to endure to be patient, and that you know that you can't pick the perfect bottom. You know that. But you also need to know that you're in the general vicinity. And that's as good as you're going to get. That the general vicinity of where this bottom could occur is as good as you're going to get. Does that mean that you're going to mess things up? It is. Does it mean that you might be a little bit early? It definitely means that. Um, and does being early give you a better entry point than being late? What strategy is the best? And why is it the best strategy? Those are all things that I asked myself when I was an early investor, and I still ask those same questions. Everyone thinks that because you're down in a position that whatever you did, that decision was a wrong decision. And I think that's just them not understanding the game. It's them not understanding how to extract the most value out of the market. Because if short-term trading was so successful, then how come a lot of people can't replicate it? How come they're not the ones with the largest rewards? They aren't. That's a fact. The majority of people who hold their stocks for shorter periods of time lose more money. So, to me, when I look at people on Twitter, I see a lot of people who don't understand the game at all. They have no idea what they're doing. And it's not me stating that I know everything. It's me knowing enough that they know too little. It's them thinking that that every position will be profitable, that every stock they enter won't go down 6, 7, 8, 10% from their position, from where they positioned in it originally. They think that the stock is just going to go straight up. It's not going to go straight up. It moves in waves. Things are going to pull back. You've got stair-stepping functions. If you don't know those things, then how the heck are you going to be successful? They don't even know the best strategies. They think that you just go in, it goes straight up, and then you get out without any sort of pain or tolerance for a pullback. And that's why I think it's so dangerous to not understand anything about the companies that you own. It's dangerous because what gets me through those short-term setbacks in the beginning of a position is knowing that what you're buying is cheap and knowing that the stuff that you own is good. It's of good value, it's a good company, etc., etc. Here's Next Wave EFT. Shale is dead. So this is what it looks like here. Wrong, 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 right. I told you there. Wrong, 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 wrong. JK, just kidding. Now it's dead. So a lot of people are trying to predict this top. A lot of people have been unsuccessful at it. But one thing I will say is that it does look like it is slowing a little bit. Now, U.S. shale production, depending on how you measure it, I do think it's peaked for oil. For natural gas liquids, I don't know yet. I don't know about natural gas, but I'm pretty confident that oil is peaked from shale. I think oil's peaked in the world in 2018. So 2018 was the peak in oil production, and then they started to add in natural gas liquids and all this other stuff. And then we'll see what we can produce. We'll see. I just kind of do a wait and see approach. It's still going up, yes, but we're seeing if it's going to roll over. I love making fun of perpetual oil bulls, but I'm starting to seriously believe there may be more of the following people than oil bulls at the moment. Energy is trending to zero. So it says excited, but wrong. Energy is trending to zero. So is energy really going to trend to zero? What would cause that? Well, you've got geology versus technology. And I think a lot of people think that technology is going to be the savior. I would, there's an argument that you could take the exact opposite case, that technology is the beginning of the end. As we get more complex with technology, as technology allows the earth to sustain higher and higher populations and demographics around the world, that technology will eventually lead to the demise of humans because it's allowed us to prosper to a level that if we hit some sort of constraint, geological constraint or something like that, that it would be a dire consequence for humanity if something like that were to occur. Maybe, maybe not. I don't know. Now, here's another thing. I just wanted to show a picture here of a stock, right? So this is a stock. I'm not going to leave it named. It's gone up since 2020. This bottom one here is Nvidia. That's Nvidia down here. So Nvidia is up 1,238. This stock in the back here is up 4,768 from the beginning of where I put it in 2020, in September, November of 2020. This top stock, this one here, is an energy company. It's an energy company. The bottom one is Nvidia. So which one would you rather be in over the past 5 years or so? Well, I'd rather take the energy stocks. They're up a lot more. At least this particular one against Nvidia. Now, this is a stock that I own. I personally own that top one. Now, I owned it a little bit from where that location is at the beginning, and I own more later on too. I bought into it even more so. And we still have a bullish formation, and it's cheap. Nvidia is incredibly expensive. What would I rather own? I'd rather own that energy stock. Why? Because it's cheap, and oil is cheap. Can you imagine if oil gets expensive? Can you imagine that? So is energy dead? Is energy the oil bulls? I'm an oil bull because we have a whole bunch of stocks that look like this. A lot of them look like that. Not all of them, but there's a lot that are really good if you go and you look and you search around. And they're incredibly cheap. I'm paying very little for them. And that's a part of knowing the game. It's a part of knowing the game. It's a part of knowing what's out there. So here's Charlie Munger. Everybody thinks you can judge people by an interview, but everybody overestimates how much you can tell in prediction by meeting somebody. We all like to think that we have that capacity, but it's a vastly stupid type of overconfidence. The paper record has about 3 times the predictive value of your impression in an interview. And of course, we're buying great paper records at Berkshire Hathaway. It's so simple. So here's another thing that I just want to talk about, and it deals with this. So I hired a lot of people. I've hired a lot of people over my previous career, as well as say. And I was in some interviews with HR and other people, and some of these were for jobs in my department or area. So most of the people that I would hire, that I would prefer if I could, I would hire them from other areas within the company. And I knew exactly what I was getting. What I call that is, if I know I have a known good, we hire them. It doesn't matter what their interview is. So I had this one person who was incredibly good. I knew that he was good. His interview was absolutely horrible. He basically didn't say anything. The other people told me that I should not hire this person. They said, nope, you shouldn't hire them. That interview is absolutely horrible. And I was the only person that wanted to hire him, and I was the hiring manager. Everyone else told me, no, the interview went horribly. Do not hire this person. And it wasn't anything to do with what they said in a negative connotation. It just he didn't say anything. It was real quiet, very introvert, very nervous. during the interview. I ended up hiring him. And they said, Andy, why did you hire him? I said, I don't hire people for interview skills. I hire them to build things, to think and build. And he's demonstrated that he can think and build in another portion of the company. Why wouldn't I hire him? I'm hiring him to do these skills. I'm not hiring him to interview. And that was my opinion there. So he's just saying that people can come off very well during an interview, and then everybody overestimates how much you can tell in prediction by meeting someone. They overestimate what they can predict from that person. And that's what an interview is. But I already know I had him knowing good. I know that, all these things that he's demonstrated before, and that's what he's saying here. We're buying great paper records. On record, this guy is really good. Why wouldn't I hire him? And that was the manager that I was. I was a manager that would look for potential in the company. And sometimes I'd say, hey, look, if you want to go work, come over to our group. You're really good. We would love to have you. We would be real flexible with you if you come over and work with us in our group. And I would poach people to some degree. Logan Matashami says economics is demographics and productivity. The rest is stamp collecting. What does that mean? The economy or economics is just the amount of people and how productive those people are. That's it. That's all it is. Bigger demographics, larger demographics, more people, more population, and more productive they are. Well, that's more a bigger economy. It's a better economy. That's it. Quality businesses, and they list all these quality businesses: Microsoft, Nvidia, Alphabet, Meta Platforms, Visa, Novo Nordisk. You go down and look at every single one of these companies. There are very few commodity companies. I see Southern Copper here, and that's about it in terms of straight commodity companies. What this is, when they say quality businesses, they're looking at the last cycle. So they're looking backwards and saying, oh my God, look at all these. These are the best. That is linear thinking. They're looking backwards at the previous years and projecting forward what they think are going to be quality businesses. Now, just because they're a solid business today doesn't mean that they're going to thrive and be the best companies in the next 10 years. It doesn't necessarily mean that, although some of these will be for sure. But it doesn't 100% guarantee that. So what a lot of people like to do is they look backwards and they say, well, the 10-year returns on this company are X, therefore I should invest in it. Because for the past 10 years it's been doing this. It's like, it depends on your market condition, depends on the cycle and where you're at in the cycle. Go back to 2007. Tell me how good the home builders looked. Tell me how good oil companies looked in 2007. They all look fantastic. They're all killing it. That was the worst time to invest in them of any time in history, basically, because then you had that gigantic pullback in 2008, and then we had the overproduction in 2014, 15, 16, in that general area. Coming down, Tavi says, let's go back here. It says the United States of America now owns 10% of Intel, one of our great American technology companies. This historic agreement strengthens U.S. leadership in semiconductors, which will both grow economy and help secure America's future, or whatever it is. Tavi says that's effectively stripping ownership from other investors, or crony capitalism. When it happens in emerging markets, the region gets condemned. When it happens in the U.S., it's applauded. It's interesting how the key structural distinction between the U.S. and emerging markets are slowly disappearing. Another thing that I would say, with all the stuff that they are doing, I would say America's jurisdiction is falling its ability to say that it's a safe jurisdiction. We are adopting things that are making it far more dangerous, at least from this perspective here. I don't like seeing government and private entities having their stock be owned by the government. That this isn't a good thing, in my opinion. Coming down, Godzilla Trader says, I was just pouring through Powell's statement, fully expecting to see some sort of major policy shift. Powell said nothing new whatsoever. Nowhere did they say they were abandoning the 2% target. And if they're lowering rates, that could be some cause for concern. And the reason I would say that is that if they're lowering rates because the market is looking weaker, unemployment, jobs, well, maybe we have a slowdown that is ensuing. And maybe the worst is still ahead of us. And maybe that's what they're seeing. Difficult to say here. U.S. commercial crude storage, including our estimate for next week, pretty low for crude storage. So that's U.S. commercial crude storage. It's on the low end. I mean, it's lower than the 5-year average. It's lower than all these, 21, 22, 23, 24 years. It's the lowest that I can see on the chart there. Remember what happens after a rate cutting cycle begins. Stocks go down because rate cuts signal a recession is incoming or has arrived. And this is what I'm worried about right here, right there. It says, I wonder how soon until the markets remember the start of the Fed cutting cycle marked the top of both the dot-com bubble and Great Recession. This time is different, though, obviously. And there's Fed cut one, or Fed cut, and another Fed cut there. And then the big move higher. I think this one was 2007. Let me see here. Yeah, 2007, 8, and this one here is 2000, 2001. That was the dot-com bubble, and this is the 2007, 8 crash. So the big question is, are they cutting into weakness? Is it politically driven? Why exactly are they cutting? And that's really the big question. If you see the yield curve uninvert rapidly, it's a recession. And that's when gold and silver take off. You could see copper go down during that time frame, and that's one indicator that you want to watch is copper. You want to see if it drops. U.S. crude oil production is rebounding, huh? So HFI Research real-time U.S. crude oil production tracking, it looks like it's going up here. Now keep in mind that they have been adding in the natural gas liquids. So that's probably what it is. If there is any, it'd be coming from natural gas liquids, but this might be throwing some people for a doozy, myself included. I'd be like, really? That's going up like that? But that's what we've got for data so far. Here's Grady. The weekend is for stepping back and looking at the very big picture. Been saying for long now that this breakout below is for real. And yesterday, silver broke out to the upside on the daily time frame yet again. The chart below was finally ready, and silver is now breaking out. And yes, I'm still certain about that silver will be a fully endorsed monetary metal once again. Many are still in a bearish mindset and sell as soon as they have some profit. If one cannot change mindset when the market changes character, making life-changing money is not possible. One of the most significant breakouts in history is in the making. And again, this is silver breaking out of its yearly closing prices. The mother of all very probable cup and handles, the bigger the base, the higher in space. We've got fractal, smaller cup and handle there, which is this cup and handle there of the breakout. The projected move, the measured move target is 800% times 31, which is $248 an ounce on this particular chart here. So that's what we've got going on with silver here. Now, why are we set up in this gigantic pattern? I think it deals with interest rates. Interest rates are the driver, and when interest rates went into a bear market in 1980s here, this is a big cup and handle in a bear market, and now we have broken out of that bear market. So has 10-year interest rates breaking the downtrend line in that. So keep that in mind. We're seeing the most bearish positioning in oil in 25 years. And in case you're wondering, yes, I'm the most bullish on oil and energy companies that I've been in years. Commodities often move in rotational cycles. And after 3 years of consolidation, I believe oil and the broader energy sector are setting up for another major move, especially given today's macro environment. With inflation reaccelerating, this is, in my view, one of the most exciting segments of the market. Needless to say, these remain among the most fundamentally undervalued businesses in the US economy. I'm excited about what I believe lies ahead for this sector. Here's positioning, it's at 25-year lows. It's generally good to be buying something when you've got setups at their lows like this. Now, could there be a slowdown in the market before oil turns? It's possible. It's possible. And that's the hardest thing, is to know with certainty if the worst is behind us or is it still in front of us. Generally speaking, silver and gold provide safe haven trades, more gold than silver. They go up when rates go down, and rates go down generally when people are worried about a slowdown, generally speaking, in history. So we'll see what occurs here. I don't know if oil positioning is low because they know that, or if it's low just because it has underperformed in the short term, and more people underperformance and sentiment just keeps going lower and hasn't bottomed yet. Peter Lynch says wonderful companies become risky investments when people overpay for them. Agreed. Home sales, gray bars are recessions. We don't have any gray bar here, but home sales have declined. So are we going to get a recession here? Are we going to print one of these gray bars? I don't know. A lot of people are saying yes. I'm in the camp that says, well, we'll see. I don't know. I like to remain open, guys. A lot of people make all these predictions about the market and they end up being wrong a lot of the time. A lot of people have been saying recession ever since we came on up here. It's like, oh, we're going to get a recession, we're going to get a recession, we're going to get a recession, we're going to get a recession. It's like, I don't know, guys. A lot of people calling for it. Novel says, we waste our time with short-term thinking and busy work. Warren Buffett spends a year deciding and a day acting. That act lasts for decades. I just like the beginning of this quote. We waste our time with short-term thinking and busy work. Short-term thinking, oh, the price has gone down. Why did it go down? Why did it go up? It's all a waste of time, guys. It's a waste of time. It's the same thing that would happen at work where I used to work. They would waste all this effort on things that you'd get no returns out of. And I just got so annoyed at it. It's like, we're going to do what? We're going to waste all this time with all these people doing all these things for that amount of output? Like, what a waste. And I think this year, the really good, efficient people and the really good investors, they focus on what they need to focus on the most. That's how they got so good. They put their efforts where their efforts have the largest rewards. So I'll leave you at that. A big move is brewing in cotton futures. Are you ready? Yeah, it looks like a pretty nice chart here. It's been coming on up. Volatility index is basically at near all-time lows. And that's generally when you get a shoot higher here. It does look like a 1, 2, 3 hump consolidation, and it ended right at this bottom. That's probably April of 2025 or something like that. It's my guess. And that's all I've got for today, guys. So that's where we're going to end it. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We do have a question and answer session later today, 5 p.m. Mountain Time. Definitely check it out if you're interested. It's a Zoom call. You can jump on, listen to what I have to say, ask questions. Usually in the beginnings, I go through some things on those, and then at the end, I do a Q&A session. All right, guys, that's all I've got for today. So we'll catch you next time, guys. See ya.